Yo, what is up everybody? I'm back again today to talk about some crucial 401k advice that you need to know, especially if you're just starting your 401k for the first time or you just started a job. So personally for me, I just started my first full-time job here about 8 months ago, and I've been studying all about investments for the past couple of years, so I knew exactly what I needed to do as soon as I started work, start building up my 401k to make sure that I have a couple $1,000,000 in the 401k once I retired, to make sure retirement is going to be great for me, to have enough money to live and to do things that I want. But if I didn't do research and I didn't study, I wouldn't know what to do with my money. I have a lot of friends who started working or are working with me who don't really know what to do with their 401k. They put money in there, they put it in certain funds they pick based on their performance just looking at it, or they put 100% stock, or they do 100% bond. But today I'm going to tell you exactly what I think most people should do when they begin, especially if they're younger and they have a lot of room to grow. But just forewarning, this is my opinion. Go to a financial expert if you want to get exact advice. But this is what I do, and it works for me great. So personally, if you are someone who is not delved deep into the stock market or doesn't do research or doesn't really do a whole lot like that but wants to have really good performance, the best thing that you can do is look for target funds, target date funds. So what are target date funds? So say that you just began work in the year 2000, and you were going to retire in 40 years. What the target date fund will do is they'll say target date 2040. So they'll set the fund for 2040 and the longevity of your retirement. And what they do is in the first 10 to 20 years, they're very heavily loaded in stocks, because stocks are going to give you a better return. They're more aggressive. They're more volatile. So the first 10, 20, 30 years will be mostly stocks. But then towards the end, in the last 10 years or so, and into your retirement, they're going to put it in something called bonds. Something that is very much more stable and doesn't jump around as much and has similar returns. So if you look at the stock market as a whole, as the S&P 500, it's returned about 8% year over year. If you looked at the bond market, it's returned around 4% year over year, but is much less volatile. So for target date funds, for people like, people who do not do a lot of research on a day-to-day basis or don't want to do research, the target fund is the best place to go. Because when you start putting in your money, it's going to be lined up perfect for you. It's not going to be exact funds that you want to do if you did a lot of research, but it's going to get you in the right place. It's going to make sure that you retire with a good amount of money based on the aggressive and what they're telling you to do, and make sure that when you retire, that if there's a stock market crash, it's not going to affect your portfolio that much. So number one is target date funds. Definitely look for that if you're not into it a whole lot. But people like me, this is exactly what I do. So I think this is the second thing that you can do. You gotta look for really good ETFs that you can invest your money in. So personally for me, I'm 24 years old, and the only time that I'm going to want to really get into bonds is when I'm really close to retirement. So say that I'm retiring at age 59 and a half or 60. I really only want to start getting into bonds when I'm probably in my early 50s, because that entire time I want to, from 24 until about 52, I want to be invested in basically 100% stocks to get the best return that I can. Because I know in 2 to 3 years, I could get very good returns, or I could get really poor returns. It could be a stock market crash, or it could be very much of a bull run. But I know over time, in the next 30 years, I'm going to get 7 or 8%. Versus if I put my money all in bonds, I'm going to get the 4 to 8%. 4 to 8%. So here's personally what I do with my investment strategy. For my 401k, I put 50% of all the money that goes into a Fidelity S&P 500 ETF index fund. So personally, I love to go through Vanguard. I talked about it in the previous video, but my work goes through Fidelity, so there's nothing I can really do about it. So 50% in the S&P 500. Then outside of that, I do 25% in a value index, which is just like blue chip stocks, similar to the Dow, like really good, strong companies with good brand, good established, very established, good revenue. That keeps that on pace. And then the third thing I put my money in is something a little bit smaller, a little bit more aggressive, which is 25% into small cap companies. So companies that are growing quickly, that aren't as much established, but will grow at higher rates. So that's what I do with my money. And it's going to stay that way, exactly that amount, until I am probably 52. So the third and final thing that you can do with your 401k, if you're lucky enough to do this outside of bonds and index funds, is you can buy your company stock or you can just buy individual stock. Yes, there's short term. Yes, there's fixed income. Those are other things, but I'm not going to talk about that because I think that's pretty low and that's not the most interesting unless you're really close to retirement. So the third and final thing you can do is your company stock or outside stocks. So my company, fortunately, gives me a brokerage where I can spend that 401k money on any investment I want. So if I want to go buy Apple stock, I want to go buy Caterpillar stock, I want to go buy Oracle stock, I can go do that through my brokerage. So you can invest like that and invest in individual stocks. I know people who have invested in just their company stock over time, which can be very good, but also can be very bad. So that's another approach, but you really need to know what you're doing, because only 12% of people who try to beat the market do. So it's almost better every time, unless you're really deep into the market, really know what you're doing, to put it in index funds where you're going to get 7 to 8% in the stock market, or put it in bond funds that are going to get 4 to 5%. So those are the best places I think you should go. If you have any questions, put them down in the comments, and like and subscribe, and I'll talk to you guys tomorrow.